The Essays of Warren Buffett Part 3, look at the business, not the market. In Part 2 we saw that an investor's very first protection is not just a good stock, but honest management. If the CEO is hiding the truth, the accounting is blurry, and the board is asleep, then the shareholders' loss can begin inside before it shows up in the market. But the story of governance doesn't stop there. In the final question of Part 2, a new door opened. Even if the CEO is honest, can he allocate capital in the right place? This very question now goes straight to the heart of investing. An investor opens his phone early in the morning. The market is red, social media is in a panic, and his favorite stock has fallen. There is just one fear in his mind: did I buy the wrong business? But Buffett looks at the same scene from a different perspective. He asks, has the business turned bad or has only the price come down? Because both things look the same, but in reality, they can be completely different. Right here, the mystery of Part 3 begins. Buffett considered himself a business analyst, not a market analyst. For him, the real game was not chasing the stock price, but understanding the economic reality of the business. Whenever he bought stocks for Berkshire, he did not buy them by looking at the market's mood. He looked at how the long-term economic prospects of that business were, and whether it could create real value in the coming years. For Buffett, the right time was not when a TV expert gave a buy signal. The right time was when a good business was available at a reasonable price, and the investor had the strength to understand it. This very thinking shocks ordinary investors, because most people consider market movement to be a signal, whereas Buffett sometimes considers it just noise. He says, imagine the market is not a machine but a human being. Name this person Mr. Market, and this person comes to your doorstep every day with a new price. Sometimes Mr. Market is very happy. He prices every business as expensive, as if no problem will ever come into the world. Then the very next day his mood changes. The same Mr. Market comes in a state of panic and starts selling even good businesses at cheap rates. Now the real question is, do you consider Mr. Market a teacher or a servant? Buffett's answer is clear: the market is here to serve you, not to guide you. If his price is sensible, use it. If the price is foolish, ignore it. The biggest freedom is that it is not necessary for you to deal every day. Right here is where an ordinary investor makes a mistake. He thinks that the market price is the truth, whereas Buffett says that the price is just an offer, not the final judgment. Think of the example of a house. If the market value of your house keeps changing every day, will you decide to sell or buy it every day? Probably not. You will see whether the house is strong or not, how the location is, how the rent potential is, and what its usefulness is in the long term. Buffett thinks the same way with a stock. A stock is not a blinking number. A stock is ownership of a business. And in ownership, the most important thing is not daily excitement but economic quality. But here is a twist. When the price falls, people get scared. Whereas if the business is strong, a fallen price can become an opportunity for a long-term buyer. Buffett gives a simple analogy like a hamburger to explain this. If someone likes hamburgers, will they be happy when the beef price increases or when it decreases? Obviously, they will be happy with the decreased price because they can buy the same thing for less money. Then why does a long-term investor panic when the stock price falls? This is the exact contradiction Buffett exposes. People who want to buy shares for years to come should not be afraid of lower prices, provided the business is truly strong. But this statement is easy only to hear. When your portfolio is red, emotion speaks more than logic. Right here is the test of temperament. In Buffett's investing philosophy, knowledge is necessary, but emotional control can be even more necessary than that. Because in a panic, the market will force you to sell. In euphoria, it will instigate you to buy expensive. And at both times, your enemy will be the same, your own reaction. Therefore, Buffett does not worry too much about short-term losses if the long-term advantage remains intact. For him, a temporary price decline is no tragedy if the earning power of the business is maintained. There is a dangerous misunderstanding here as well. People think that the long term means holding on to any stock and just sitting tight. Buffett does not say that. The long term is meaningful only when the business quality, management trust, and economic prospects are right. Holding a weak business for a long time is not patience, it can be slow damage. Therefore, Buffett's first job is analysis, not prediction. He asks, how does the business make money? How does it protect itself from competition? Where does it deploy capital? And what are the future economics? A market analyst asks, where will the price go next quarter? A business analyst asks, will the strength of the business last for the next 10 years or not? This difference is not small. This very difference builds a wall between speculation and investing. Now comes the matter of value. Buffett's goal is not to buy a cheap stock. His goal is to buy a wonderful business at a reasonable price. This line is very important, because many investors mistake a low price for a bargain, but a stock that appears cheap can many times be the trap of a bad business. If an average business is available very cheap, a short-term profit might be possible. But Buffett's preference is a business that keeps creating value on its own over time. Because a great business can become a compounding partner for the investor. A mediocre business can demand patience and capital from the investor time and again. Right here, Buffett's thinking is seen moving ahead of Benjamin Graham. Graham taught bargain buying, but Buffett gave more importance to the art of buying quality at a reasonable price. This does not mean that price is not important. Price is very important, but price alone is not enough. If the business is weak, even a low price cannot provide protection. And if the business is extraordinary, even a slightly reasonable premium can be meaningful in the long term. But then the question comes, how does one know that a business is extraordinary? This is exactly where the investor has to understand their circle of competence. Buffett says, invest in things that you truly understand. Do not invest just because a trend is going on in the market. If you are simply unable to understand the business model, the growth story can attract you in a more dangerous way. Because in an unclear understanding, confidence is fake. The investor thinks that he knows, but in reality he is only repeating the opinions of others. For Buffett, independent thinking is necessary. Look at facts, understand the business, trust the management, and then take your decision. Here comes the talk of diversification, and Buffett's view might look a bit different from traditional finance teaching. Traditional investing says to do a lot of diversification to reduce risk. Buffett says if you understand the business, blind diversification is not necessary. But this does not mean that every investor should make a concentrated portfolio. Buffett's point is that do not use diversification to hide ignorance. If knowledge is low, diversification can provide protection. But if there is a deep understanding, focusing on the best opportunities can also be powerful. This is exactly what many people misunderstand. Buffett is not against diversification, he is against spreading without understanding. He says that jumping into something you have no knowledge of, just out of excitement, is dangerous. Whether it is a new sector, a hot IPO, or a tip from a friend. Now comes the turn of beta. In finance textbooks, beta is considered a measure of volatility, meaning how much a stock moves compared to the market. Buffett finds measuring risk solely by beta to be incomplete. For him, the real risk is permanent loss of capital. If a stock price moves sharply, a textbook might call it risky. But if the business is strong and the price is attractive, Buffett can consider that volatility an opportunity. On the other hand, a stock might look calm, but the business inside could be weak, the debt heavy, and the management confused. In such a scenario, even a low beta cannot save the investor. Right here, the hidden truth of investing comes forward. Risk is not just price movement, it is also misunderstanding. If you do not understand the business, even a stable chart can be dangerous. And if you understand the business, even a falling chart can become a chance. Buffett also talks about arbitrage when he doesn't find any large, attractive investment idea. In arbitrage, the investor tries to earn returns from price differences in different markets or deal situations. In a simple example, if an asset is cheap in one place and expensive in another, the price difference can become an opportunity for profit. But this game is not easy. In arbitrage, one has to understand facts, timing, transaction costs, and deal risk. Jumping just by looking at a price difference is not wise. Buffett looks at this too as an independent evaluation, meaning whatever the strategy may be, the decision should be based on facts, not on fashion. This is the core of Buffett's investing philosophy. Sense is more important than style. Value investing, arbitrage, concentrated bets, long-term holding, all have meaning only when the thinking is clear. Now think of a real-world scene. The market is falling, experts are giving different predictions, and your stock is 20% down. An ordinary investor asks, how much more will it fall? A Buffett-like investor asks, has the earning power of the business changed? If the answer is no, then a lower price is not a fear, it can be an advantage. But if the economics of the business are breaking down, then the drop can be a warning too. This very difference saves the investor. Not every dip is a buying opportunity, and not every fall is a danger. Buffett's approach demands judgment. Just a formula does not work, because a business is a living system. Management can change, competition can increase, customer behavior can shift, and capital allocation can go wrong. Therefore, in Part 3, finance and investing is not just a technique of buying stock. It is the art of hearing the real voice of the business amidst the noise of the market. In Part 2, we saw the honesty of the CEO. In Part 3, we see that after getting honest information, the investor has to understand it and take an independent decision. Because getting the truth is the first step, using that truth correctly is the second step. Buffett does not free the investor from fear. He gives them a way to think in the midst of fear. He says, learn to ignore the market, but do not ignore the business. Look at the price, but understand the value. And most importantly, do not make investing a prediction contest. Make it an ownership journey, where patience works only when there is truly an understanding. The payoff of Part 3 is just this. In Buffett's world, a smart investor is not the one who can tell tomorrow's market, but the one who can clearly see today's business. But the most difficult question is still left. If a good business is found, the management is honest and the price is reasonable, then is it enough to just buy and sit tight? In Part 4, the story will go into the depths of capital allocation, earnings, and accounting. There it will be revealed whether the company is just showing profit or truly creating wealth. Because in Buffett's view, earning money is one thing, and deploying that money wisely is quite another. The real compounding machine begins right from where the ordinary investor often stops looking.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.